Let's talk about something super important in crypto trading: liquidity. So what is it? Imagine you have a rare collectible card and you want to sell it. If there are tons of people ready to buy it right away for a fair price, that market is liquid. In the world of cryptocurrency, liquidity is exactly the same idea. It's all about how easily you can buy or sell a crypto coin like Bitcoin or Ethereum without causing a massive price swing. A market with high liquidity has a lot of buyers and sellers actively trading all the time. This means there are always people on the other side of your trade, ready to do business with you. Now, why should you even care about this? Well, high liquidity is like a safety net for your trades. When a market is liquid, you can get in and out of your positions quickly and at a predictable price. This is because the gap between the highest price a buyer is willing to pay, which is called the bid, and the lowest price a seller is willing to accept, known as the ask, is very small. This tiny gap, called the spread, means you lose less money just by placing a trade. Think of it as paying a very small fee to enter the market, which is always a good thing for keeping your profits. On the other hand, a market with low liquidity is a trader's nightmare. This is often called an illiquid market. In these markets, there are very few buyers and sellers. If you want to sell your crypto, you might have to wait a long time to find someone willing to buy it. Even worse, you might have to sell it for a much lower price than you wanted. A single large order can send the price crashing down or rocketing up, which is incredibly risky. This volatility can wipe out your investment in a flash, making it a dangerous place for beginners to trade. So for anyone starting out, focusing on high liquidity markets is one of the smartest moves you can make. It makes your trading experience smoother, cheaper, and a whole lot safer. When you trade something popular like Bitcoin on a major exchange, you're swimming in a deep pool of liquidity. You can buy a little or a lot, and the price won't suddenly jump just because you placed an order. This stability allows you to focus on your strategy instead of worrying if you'll even be able to complete your trade at a fair price. It's the foundation of smart, low-stress trading. Alright, so we know liquidity is good. But how do you actually find it? It's easier than you might think, and you don't need any fancy tools. The first and most important indicator to look at is the 24-hour trading volume. This number tells you the total value of a specific cryptocurrency that has been traded on an exchange over the last day. A high trading volume, say in the hundreds of millions or even billions of dollars, is a clear sign of a very liquid market. You can find this information on almost any crypto exchange or on data websites like CoinMarketCap or CoinGecko. Another key thing to check is the order book. The order book is a live list of all the buy and sell orders currently open for a cryptocurrency. For a liquid market, you want to see a deep order book. This means there are many orders stacked up at various price levels, both on the buy side and the sell side. It looks like a long, dense list. A shallow order book with only a few orders scattered around is a red flag for low liquidity. A deep order book shows that there is strong interest from many traders, providing the stability you need to trade effectively. Don't forget to look at the bid-ask spread, which we touched on earlier. The spread is the difference between the highest buy price and the lowest sell price. In a liquid market, this spread will be very tight, sometimes just a fraction of a cent. For example, if people are bidding to buy Bitcoin at $60,050 and others are asking to sell at $60,075, the spread is tiny. A wide spread means the market is illiquid and you'll lose more money just to make a trade. Always check the spread before you enter a position. It's a direct cost to you. Finally, stick to the major well-established exchanges. Platforms like Coinbase, Binance, or Kraken tend to have the highest liquidity for popular coins because they have millions of users. Trading a major coin like Ethereum on a huge exchange is the perfect recipe for a liquid market. New or obscure exchanges might offer tempting new coins, but they often suffer from low liquidity, making them much riskier. Start with the big players where you know there will be enough trading activity to support your strategy and keep your funds safe from wild price swings. Once you know how to find liquidity, you can start using some simple strategies that take advantage of it. One of the most common is called market making. Now this might sound complicated, but the basic idea is simple. A market maker places both a buy order and a sell order for the same crypto at the same time. The goal is to profit from that tiny bid-ask spread we talked about. For example, You could place a buy order for 1 Ethereum at $3,500 and simultaneously place a sell order for 1 Ethereum at $3,500.50. If both orders get filled, you've just made 50 cents. This might not sound like much, but market makers do this hundreds or thousands of times a day. Over time, those small profits add up to a significant amount. This strategy works best in highly liquid markets because you need a lot of trading volume for your orders to get filled quickly. You are essentially providing liquidity to the market, making it easier for others to trade and getting paid a small amount for doing so. Automated bots are often used for this, but the principle is a great way to understand how liquidity directly creates profit opportunities for traders. Another popular strategy is arbitrage. Arbitrage involves buying a cryptocurrency on one exchange where the price is lower and immediately selling it on another exchange where the price is higher. For instance, you might see Bitcoin trading for $60,100 on exchange A, but for $60,150 on exchange B. An arbitrage trader would quickly buy Bitcoin on exchange A and sell it on exchange B to pocket the $50 difference per coin. This opportunity for risk-free profit exists because of temporary price differences between markets. For arbitrage to work, you need high liquidity on both exchanges. You must be able to execute your buy and sell orders instantly without affecting the price too much. If the markets are illiquid, your large order could push the price against you, erasing your potential profit before you can even complete the second trade. Speed is everything in arbitrage, and these price differences usually only last for a few seconds. This is why many arbitrage traders use bots to spot and execute these trades faster than any human could. While these strategies sound great, it's important to talk about the risks, especially for beginners. The biggest risk in liquidity trading is something called slippage. Slippage happens when you place an order at a certain price, but by the time the order is executed, the market price has changed. In a fast-moving, low-liquidity market, you might end up buying higher or selling lower than you intended, which can lead to unexpected losses. This is why sticking to highly liquid markets is so crucial, as they have less slippage. Always use limit orders instead of market orders to set the exact price you are willing to pay. Another risk, particularly with arbitrage, is transfer times and fees. When you move crypto between exchanges, it isn't instant. It can take several minutes or longer. And during that time, the price difference you were trying to capture could disappear. Plus, you have to pay withdrawal fees on one exchange and trading fees on both. These costs can eat into your profits, so you must calculate them carefully to ensure the trade is actually worthwhile. For market making, the risk is that the price moves suddenly in one direction, leaving you with an order that is now at a loss. So here are a few simple tips to stay safe. First, start small. Don't throw your life savings into these strategies on day one. Use a small amount of money that you are comfortable losing while you learn the ropes. Second, stick to what you know. Begin by trading highly liquid pairs like BTC to USD or ETH to USD on major exchanges. Avoid obscure altcoins on small exchanges until you have a lot more experience. And third, do your homework. Understand the fees, the risks, and the platform you are using before you place a single trade. In the end, understanding and using liquidity is a game changer for any crypto trader. It's not just about finding opportunities to make money. It's about protecting yourself from unnecessary losses. By learning to identify liquid markets, you make your trading smoother, more predictable, and less stressful. Strategies like market making and arbitrage show how you can turn liquidity into a direct advantage. By starting slow, managing your risks, and focusing on high-quality markets, you build a strong foundation for long-term success in the exciting world of cryptocurrency.